Welcome to the Fintech 2022 end of year wrap up, and to give you a bit of Christmas cheer. This year we've donated, instead of sending out Christmas cards in the mail, to Beyond Blue. COVID-19 has been a strong feature throughout the year again, but we're pleased to say the numbers of cases are dropping, much less hospitalizations, and we hope we're seeing the end of this little pandemic. What's really now coming into play and moving into 2023 is one word: inflation. So inflation is really driving the agenda around economies, markets, investments. And why is that? Well, when COVID first hit, all the governments around the world injected a lot of money into keeping things going smoothly and making sure that we could all recover and get through this situation. As a result, now we've got a boost in inflation, the costs of goods going up, and in addition we've had some other dynamic, including Russia invading the Ukraine, supply constraints around the world. We already had supply constraints related to COVID when people weren't working. So prices have stayed up when we thought they might be transitory, but they actually haven't been so much. So now, as you would have seen during the year, quite quickly, really from April, where we were at 10 basis points, or 0.1% was the official cash rate in Australia, it's now at 3.1%. So the RBA increased interest rates by 25 basis points, or 0.25% in December. They don't meet again in January because of the Christmas holidays, but in February they may increase again, or they may pause, but we do think there's potential and possibly going to be a little bit more increasing interest rates because inflation is just sticking too high. In the US, it's even more aggressive. We're seeing rates going up to higher levels again, and it's all driven by things like employment and wages growth. So until there's a containment on how much wages are going up and how employment is going, currently it's still quite strong. So the governments and the central banks are really being pushed to let's dampen the economy down. It's effectively what they're doing. On the negative side of that, there is going to be a consequence, and that will be an impact over time because of a lag effect. There's a lag from when central banks put up interest rates to then when it actually flows through and affects people's back pockets. One of the interesting ones in Australia is the fixed interest rates that happened when COVID hit, and people were getting home loans for around 2%. Some of those are 2-year, possibly 3-year terms. So those are coming off those fixed terms starting in 2023. So people who have been paying a much lower monthly repayment on their mortgages are going to have, in some cases, a 60 or 70% increase in the amount of repayment they're going to have to make. So we know that's going to impact. It will also impact on businesses, and the lag will flow through to how businesses' profits flow through, and that will affect the share prices. In addition, we may see some more pressure or headwinds into property itself. And of course, that won't apply to all property, but generally speaking, I think things will be a little bit dampened for the next year or two, possibly longer. Having said all that, we're really pleased to advise that your investments and the portfolios and how we run things for you, in conjunction with all of the financial advice and strategies we do, have been going really well. So we've managed to dampen the impacts of negative market returns. During the year, the US was actually down over 20%, and the US does have quite high valuations compared to Australia, a lot of technology companies and other large growth companies. Australia is not so impacted by that. We have had a negative up at one point minus 10%, but things have come back a little bit into the end of the year. We are expecting more volatility, so we just want to give you some certainty that we think that's going to work out okay. The way we're investing and structuring your portfolios is based on your own risk profile and what your circumstances are. However, we are focusing on companies that we know do better in increasing interest rate or inflationary environments. So I am looking forward to working with you next year. We're very grateful to have you as our clients, and we do want to wish you and your families a safe, happy and fun Christmas this year, hoping you're getting a good break.